Here we go. Stocks by the numbers. Welcome back. Quick update here on Dutch Brothers Incorporated, ticker symbol BROS, listed here on the New York. Stock closed at 35.10, down about 80 cents, roughly 2.25%. You can see it's up about a nickel after hours right now. Let's find out what's going on. We initially looked at this stock back here May 20th. As you see, stock was kind of sitting between about $36, $37 a share, and not much really has happened. In the short term, we had a little sell-off after we looked at it. Then we rallied up to about 43.5, hitting new 52-week highs. Stock begins to step down a little bit coming into these earnings. We have yet another EPS and revenue beat. The company has been beating these estimates more times than not, which is why I said back here, in my opinion, seems like a steady grower. But again, we can see we popped, we dropped. Now we're kind of basically back to where we started. So if you jumped in back in May and you've been holding on this whole time, not much has transpired for you. But I just want to look at what can potentially be coming over about the next 12 months. So big EPS surprise here. This kind of took a lot of people back because first of all, the revenue estimate, as you see here, 317.385 million. Before that, that was this quarter here. Before that, you can see revenue was sub 300 million. 275, 254, 264, 249, right? So this was the first estimate that jumped us up above that 300 million milestone mark. And the company comes out, they report almost 325 million. They beat it by about 7.5 million, and the profitability just surged for this quarter. And they beat these EPS estimates by about 50%, posting 19 cents a share. Estimates were sub 13 cents a share. So very nice beat on the top and bottom line for Bros. And the real question now is, are they going to be able to do it again? And we can see that revenue estimates now are essentially in line with what the company just reported, right? 324.8 million, roughly, we'll call it, on EPS estimates of about 11.5 cents a share. So obviously, we don't know what's going to happen. They could beat again. They could come up short, of course. But I will say this: too much coffee. This is the last 4 quarters of the EPS estimates, right? And you're noticing a trend. You're noticing that while estimates are bouncing around, right? We were dropping for a couple of quarters, then we spiked up a little bit. We can see that this company is really more profitable than Wall Street is anticipating. I mean, we have a beat here more than a double. And we have a beat here of about a double, posting 4 cents on estimates of 2 cents. And we have a massive beat here. They thought the company was just going to go slightly positive on 1 cent a share. The company ends up posting 9 cents a share. And now again, for last quarter, they bump estimates up to 13 cents a share, and the company posts 19 cents a share. So if the company even misses on the revenue, let's say they bring in like 315 million or something, they miss the mark. In my opinion, the profitability side doesn't seem to be an issue right now with Bros. So I think the profitability side, in my opinion, seems potentially pretty set in stone. The real question is, they just had almost a 325 million breakout revenue quarter. Are they able to do it again? That's the real question. So let's find out what everyone's thinking and how everyone feels about it. First of all, in the numbers, 5.4 billion market cap. Honestly, could be viewed as a little overextended. We'll crunch the numbers in a second. We're trading about 140 times earnings, which of course could be viewed as overextended. However, the company, again, saw their profitability decrease over several quarters, almost back to flat, and now we've spiked up. So as we continue to report growing and healthy EPS, that obviously PE ratio is going to come more and more in line and more back down to earth. But you can see, minus this Q4 drop, even in profitability, for the most part, the net margin percentage has been consistently increasing. 1.1%, almost 1.6%. Then you had the dip, right? Then we bounced back to almost 2.6%. As of last quarter, 3.6%. So we're in a good space here because I know we've seen a lot of other stocks that are kind of up and coming. You know, they're starting out, they're beginning to grow. And sometimes we see cases where we have random capital expenditures or some issue has arose. And we'll see that even though we occasionally bring in more revenue, we may suffer the same, if not sometimes wider losses than we expected, even though the business brought in more money. And obviously, you're seeing kind of the inverse scenario here with Bros. We're seeing a company that, for the most part, is consistently growing, and we have what looks to me a pretty healthy business in the numbers, which is why, as you see, the more revenue the company brings in, the more profitable they are. It's very black and white, it seems, in my opinion, right? There's not much of a gray area taking place here. But also, we looked at the revenue growth over the years, and again, we saw the profitability drop down from flat to negative 2.5% coming out of those lockdowns there in 21. And then we can see for 22, revenue jumps from $500 million up to about 739 million. Net margin almost break even. And now for 2023, revenue jumps up to 965 plus million, and the company brings in a couple of bucks for 23. But if we go back for Q1 and Q2 of 24, we can see we have been net income positive on growing revenue for the first half of 24 so far. So if everything stays the course, then it looks like 2024 is going to be a billion plus revenue year. And of course, that net margin percentage may jump up to, roughly like 2 to 3% maybe to close out the year. We have to see. But you understand what I'm saying, that we're stepping up. So we had Q2, now we have Q3, right? If we look at this time last year, Q2, 250 million, we'll call it. Net margin 1.1%. Look at Q3 though, we jumped up to 264.5 million, and we're a little bit more profitable. So based on historical trends, and again, of course, previous performance does not dictate future results, but we can see that Q3 last year generated a little bit more revenue than Q2. So if Q2 just brought in 324.9 million, estimates dipped down to 324.79 million, then again, based on what they did last year, this number might come in at 327 million, 330 million, right? So the revenue also might be kind of, we can't say cemented as a beat, right? Because we know nothing is guaranteed. But in my opinion, I would probably give the company the benefit of the doubt. But the real question is the stock going to go up? Because again, last quarter, we had a nice beat and the stock ended up dropping down. We had a big bounce back up to the 20-day, it looks like, up to about 37.5, hitting a high of 38.75. Then earnings come out, they beat, and the stock, my apologies, and the stock drops to sub 27. So we went from 37 to 27 on an earnings beat. And in my opinion, I think it's because you can make the argument that it's overvalued. So what you may see is something that might not make sense logically, but will probably make sense more over the longer term, which is why I wanted to kind of give my personal prediction over about the next 12 to 18 months. So we had a big drop down on an earnings beat, and then you can see we basically just slowly step back up to where we were, right? So if we have another drop down on an earnings beat, we may continue to step back up to kind of where we were going into next quarter, right? You understand what I'm saying? But either way, in my opinion, I do think it's growing nicely. They're slowly becoming more and more profitable. We mentioned back here at the time, they said they would just open like 150 more locations. So obviously there's demand for their locations, their product, again, coffee, beverages. And like I said, if people are beginning to shift away from the main players in the spaces, like the Starbuckses, then as a company like Bros is obviously going to pick up the crumbs of the fallout. And we can see that, again, with the consistently growing revenue. And there doesn't seem to be many issues on their end because they are remaining profitable and slowly stepping it up. So, just looking at the technicals here, I mean, these blue lines, as you see, is kind of this upward channel after the chunk down since last earnings, right? So these blue lines here is your upward channel that we've been in since August earnings. Now we can see that we had the drop here towards the bottom. So I drew connecting from that bottom there, October 10th to October 11th. Let me zoom in a little bit. You can see how I just went from the bottom to the bottom and came up right there. So we have a couple of shorter term support trend lines that of course you want to see the stock hold. And after we had the double big green pop here on the 11th and the 14th coming off of the bottom of our channel, you can see that we've kind of tightened and just slowly been stepping up. So if we connect the bottoms of October 15th to the bottom of October 23rd, you can see this is also kind of your immediate short-term support level. And if we were to pull back immediately tomorrow, you're looking at about 34.84, 85 on my screen, somewhere around there. And then, of course, if we happen to break, we can come down to this support trend line, which would meet up right here with this other trend line, as you see. And you're looking at about maybe about 34 and a third. So we may continue to pull back a little bit. But again, we may pull back here in the morning to the high 34s and then bounce and just kind of stay in this range, right? But what you really want to see, in my opinion, is staying inside of this channel. Again, these two blue lines here. Hypothetically, if the stock immediately dropped down to the bottom of this channel tomorrow, you're looking at about 31.80. You're looking at sub $32, which again is why I'm saying we can potentially drop even on an earnings beat and then slowly continue to step up. So again, it could kind of go either way because we've already seen that happen last quarter. So in my opinion, I would say that I feel the company's probably going to beat those estimates. And this orange trend line here, as you see, going back from the initial pop coming right out of the gate in 2021, about 3 years ago, exactly to the day. Look at this, October, oh no, wait, that wasn't the day. It was right there, November 1st. But November 1st, 2021, you can see 81.40. And we go from that absolute top to the most recent top here on July 9th, 2024. So you can see that that trend line here, if we were to just kind of flatten out and stay here going into earnings and then the company beats, if we immediately jump up to that trend line, you're looking at about potentially $40. And believe it or not, even if it does beat estimates and pop up to around 40, barring some, big positive catalyst to follow the earnings report, like a stock buyback or something, then in my opinion, even if it does want to run up to 40, it may run into big resistance there and actually reject and come down. And I'm going to explain myself here in the numbers, because we like to look at the numbers here, because men lie, women lie, numbers do not lie. So, if we look at the debt, we can see we went from 700 million change down to about 650 million. We've slowly been stepping up for the last couple of quarters. However, again, if the company is seeing big demand for their locations and their beverages, then I guess that's why they're taking out loans. And they said, again, they're opening whatever, 150, 200 more locations. So we have to deal with the short-term debt, the short-term redness, to hopefully get that bigger and better green coming in, 6, 9, 12 months from now. But debt is still sitting here at sub 1 billion. If we look at something like the free cash flow as well as of last quarter, you can see, again, this was Q2, you can see free cash flow minus 4.9 million. If we go back to this time last year, free cash flow was minus 16.25 billion. So this is what we're seeing. We're seeing a lot of the fundamental metrics slowly inching up and moving in the right direction, which technically is what you want to see. Of course, the debt is higher. Again, we're up here to almost 911 million. We're sitting here with about 261 million in cash right now as of last quarter. We have assets outweighing liabilities in both the short and the long term, which technically is a good sign. But let's crunch some of the numbers here. Let's look at the equity. As we see, almost tripled over the last roughly 18 months. Equity used to be about 252 million. Now it's up to about 730 million. So it's growing very nicely here. The book value, again, essentially up double. We hit this 465 in the second half of 23 and slowly stepped down about 20 cents a share. But you can see we've been maintaining now for the last 2 quarters. And also, even if the company hypothetically misses this next quarter, you can see, look at the estimates moving forward. We're expecting to maintain this $300+ million level for Q4. And now you can see going into 25, back up above 327 million, and then almost 400 million roughly this time next year. So that's why if you're a long-term holder and player here for BROS, you may have to deal with some short-term volatility here from quarter to quarter. But over the longer term, in my opinion, I think the business is going to be more than fine, especially since it's beverages and we're talking about coffee. I mean, obviously in America, we love coffee. So that's why something like BROS over time probably going to be fine. And even over the years, you can see, again, if we look quarterly, we had a couple of misses, but we have mostly beats for the most part. But if you look annually, the company is technically coming in above Wall Street's estimates since they went public. So this technically over the longer term is looking even better, in my opinion, than maybe a short-term snapshot, right? And we can see for 2024, estimates are up to almost $1.25 billion for revenue. 2025, we're expecting almost $1.5 billion, then about $1.75 billion. Then we're going to break potentially to 2.15 billion. So slow and steady wins the race, in my opinion. The problem, though, is that it may have just come out too expensive right out of the gate, which is why you had kind of the initial pump and the craze off of it. And then you can see, look, this is what, November of 21, and then we just went into a downtrend, even though the company was probably, growing nicely. You can see we went into a downtrend for almost 2 years. Then we may have bottomed out there in the low 20s, and then people felt it was kind of more, quote unquote, fair valued, and they started to step in. It started to gain some momentum and gain some attention, right? But what bothers me here is that as we were on the way up, we have a low here, 2691, and we have a low here, 2696. So technically, we are making higher lows. That's why this one right now, in my opinion, does seem a little difficult because, if people are bullish on it and they expect a break up here, it's like to this line to 40, I can understand it. If they expect even a break up even higher here to make higher highs, and we're going to hit maybe 43, high 43s, 44. Believe it or not, I can see it. But also at the same time, looking at the numbers, if we're expecting another drop down, even if we beat, and we're just going to continue to slowly step up, in my opinion, I could see that as well. So this one may be pretty difficult to call. So I'm not exactly sure, in my opinion, if I would look at this as like an earnings play. I would probably more look to this as a longer term investment, playing on that growth. And this is probably one of those situations where, you start building a position in the 30s. If we do happen to pull back to the mid-low 20s, you can add more there. Because if we look at the overall pattern, we have this big symmetrical triangle potentially lining up, right? And if we're kind of overvalued in the numbers, but also could see growth, then what that tells me is that even if we pop up here to 40, we may immediately reject and come back down here into the 30s and then just kind of step and channel as we approach the apex of this triangle into 25. And then when everything lines up, that's when you're going to have the pop up and the breakout of the triangle, right? So this may be one that might not show you too much movement over the next, 6 to 12 months. However, we may turn around in a year and a half, and the stock is up here at 45, right? And it was all you can eat down here in the 20s and the 30s. So this is why this is a pretty interesting play, but technically in the numbers, in my opinion, it is growing. But I just go off on a tangent all the time. So total equity, 730 million, we'll call it. Cash, 260. So we're at 990 roughly. We have 910 debt, which leaves us with about positive 80 million. So now we come over here and we look at the numbers. As of last year, 965 million plus 1.7 million in profit. That's 967 million, we'll call it. Plus, what we say, 80 million. So that puts us slightly over $1 billion, in my opinion, quote unquote, fair value. And you can see the market cap right now, 5.4 billion. So we're trading roughly 5 times, quote unquote, fair value. Also 140 times earnings. And also, over 5 times last year's annual revenue as well. So depending on how you want to look at this, you can potentially make the argument for either direction. Also, book value, even though it chunked up nicely and it's kind of been holding this 4.5 level, it is still 447 is the book value per share. Stock right now, 35. Right? So we're trading at a pretty high price to book ratio as well. That's why it's hard to tell what's going to happen in the shorter term, but in the longer term, technically, you should be fine. but it may just remain quiet for a while before you really have that breakout. But we can see the PE was up here significantly higher, several hundred, was over 1,000. Then the last couple of quarters, we pulled it back. 179, 164 times earnings, 142 times earnings. And we've seen other companies kind of go through this whole transition of moving away from a little bit of the hype so that the numbers could readjust and come back to reality, right? So that's why even if the company reports some good earnings for the next quarter or two, if we start to see this PE step down, 130, 116 times earnings, believe it or not, it would be justified. Because this is what I always say, we have to readjust the stock and bring it back down to reality. So where it gets to a point to where all of the numbers line up, it'll probably be approaching that apex of that symmetrical triangle we looked at. And then more times than not, the majority of people looking at the stock will look at the numbers and they'll say, no, this stock is undervalued, this stock is due for a pop, and you're going to have a breakout. Almost very similar, and I know there were some other outside catalysts attached to it, but if you think about it, almost very similar to what we just saw with Centrus, LEU. Right? The stock was in a long-term symmetrical triangle, but we looked at the numbers. I said, in my opinion, the stock's actually undervalued, and we should probably see a break up out of the triangle as opposed to a breakdown. And that stock went on a tear. It went from what? $38 to $100 a share recently. But similar situation, right? We may still be in that triangle like we were with LEU now with Bros, and it may take 6 months, 9 months, but as we approach that apex, hopefully if the company does bring in that higher revenue as we expected and they become a little bit more and more profitable, then as we approach the apex, Wall Street's going to say, okay, we're in a big symmetrical triangle, the numbers have been growing healthy, the business has been maintaining, so we have to break it up and out. We can't let it break down. You understand what I'm saying? So in my opinion, I think that's what's going to happen, but of course, only time will tell. If the company, as I said, beats earnings handsomely and then announces some sort of share buyback or something, we may just immediately pop up to the 40 and break above that all-time resistance line. So we have to keep an eye on these earnings. But again, in my opinion, I'd give them the benefit of the doubt. But last earnings, they beat, and the stock dropped from 37 to 27. So just keep that in mind. Price to sales now, we're trading about 3.25. Last quarter was about 3.8 times sales. Before that, though, you can see we were hanging out in like the high ones to the mid twos. So that's why, again, this could be viewed as a little overextended. We're trading about almost a little less than 19 times cash flow, which actually doesn't seem too overextended. That seems basically in the mean average there. Price to book, we're trading 8 times book. We were significantly higher again, but at this time I was saying that the stock could have been viewed as overvalued. So we bring it all the way down to the low 20s, and now we're kind of slowly stepping it up as we can. As of the last couple of quarters, you can see 7, 9. Now we're trading 8 times book value, so perhaps not as overextended as I initially thought. Enterprise value supposedly is what another business would be willing to pay for this business. And you can see that right now it's 6.4 billion, market cap 5.4 billion. So I guess that's a good sign, but we know that this number always changes off of recent stock price activity as well. So not exactly sure how much weight I put into that. All of our return percentages were slightly negative, came back flat, and now have slowly been increasing over the last several quarters, which is a very good sign. Gross margin percentage was bouncing around here, maintaining in the 20s, got up to about 28 1/3. Slight pullback there, drops down to 23, and has slowly been stepping up 26, almost back up to 28. So that's what I mean. Depending on how you're looking at it, you could make the argument, well, it's not as good as it was, so we're keeping it down. Or, oh, we beat it up and, these numbers dropped, but now all these metrics have been increasing, so we got to bring it up. So that's why, again, you could kind of make the argument for either way, but these margin percentages are very important when it comes to the actual business operations themselves. And the fact that they're, for the most part, maintaining or rebounding to where they once were, in my opinion, very good sign, especially with the company, sticking their neck out a little bit, opening up a bunch of new locations, taking on some red numbers on the balance sheet, increasing the debt. So it does seem like everything's still kind of copacetic. And it should really lead to future growth, in my opinion. But gross margin percentage, again, growing nicely. Operating margin, of course, is a key metric, and you can see slightly positive, went slightly negative, stormed back up to about 9.33%, drops back flat, and then instantly rebounds back up to 9.33%. Now, as of last quarter, almost 10% on the operating margin. So this is why, again, if you're going to tell me I like the stock, I think it's going to 40, I can't necessarily blame you. And even though we try to be conservative on this channel, I try to be a realist, and looking at some of the metrics, if the stock does pull back to 32 and change, it would make sense to me. But also at the same time, we know the markets have been raging, and we're kind of rewarding a lot of these companies who are being more consistent than not. So that's why if Dutch Brothers puts another earnings beat notch in their belt, maybe we could see $40. I don't know. I honestly don't know. You know, I'm always honest with you. That's the way I'm calling it. But long term, I do like it. EBITDA was in the 8s, doubles up to 15, 17 and a quarter, drops down to 8.6, and then storms back up to 14.7. Now, as of last quarter, 14.8. Highest it's been? No. Took a big hit and then almost rebounded all the way? Yes. So, in my opinion, pretty decent sign there. Net margin percentage we spoke about was dipping down negative, bouncing around slightly positive, 1.6%, goes back negative. Then the last 2 quarters, over 2.5%, over 3.6%. So as we're expanding the business, we're becoming more profitable, which technically looks really good. Certain things like the inventory turnover took a big dip, going from 18 down to about 15.6, and has slowly been stepping up. The asset turnover, though, as we see, has actually taken a hit, gone from 0.85 down to 0.6. But again, in my opinion, I think that they have to, again, take on some dipping fundamentals, regardless of what and where they might be here in the short term, to look for that long-term growth. And that's why, again, I know I say it all the time, but if we turn around, 2 years from now, we may get to a point where this gross margin percentage at 27% is up to 37, 41%. Operating margin here at sub 10% could climb to, 17%, 21% over the next year and a half, 2 years. So that's why it may be kind of foreshadowing what's going to be in the numbers in the next year and a half, 2 years. That's kind of the way I'm looking at it. But our debt ratios, yeah, all of the other numbers, the assets, the equity, have been growing nicely. So even though the debt went up, you can see the debt ratios are technically down a little bit over time. We don't get paid a dividend. Again, earnings for the most part, profitability side hasn't been an issue, really. 6 beats in a row. The revenue side, going back the last 7 quarters, we had these 2 misses, and we have 5 beats. So this is why, as of right now in its current state, I'd give them the benefit of the doubt going into earnings. But again, you could make the argument that the stock could go either up or down. But again, if we extend out this potential long-term symmetrical triangle that the stock may want to stay inside, I just want to show you what could potentially happen. Look at that. We can, again, bounce up and down inside of this. I mean, look at this. Technically, the apex, we're talking April of 2026. And I know it may suck, but it may take that long. But again, even if we want to prematurely break out, you can see we're looking at maybe right around this time next year. So this is one we're going to have to take quarter by quarter, because we don't know exactly what's going to transpire every 3 months. Again, we could hear about an activist taking a position. We could hear about a big stock buyback repurchase program. So we could have a catalyst that can send us out of the range or even below the range. So we have to wait and see. But according to the recent news also, we've had a lot of insider selling, apparently, with this company. You can see this person here, 10% owner, sold 80,720 shares for about 2.9 million. Now has control over about 125,000 shares, but just sold 80, right? So what's that, like 40%? Roughly. Yeah, it's about 40%. So again, we know, insiders buy and sell stock for different reasons, but that one was kind of interesting to me, seeing all of these recent reports here. We have DM Trust Aggregator, both holding 10%. Okay, so 40,397 shares at a whop of 36 roughly, totaling 1.45 million. So they sold 40,000, still maintaining 223,000. So that was, yeah, what, roughly maybe like 20%-ish? 40,000, weighted price 36.02. Indirectly owns 125,000. So yeah, it seems like they trim positions maybe about 20-25%. Calling it an aggressive growth stock. Restaurant stocks, let's see what they say about this. Restaurant revenue up. Fed rate cuts to help restaurants. Yeah, sure. Dutch Brother, drive-through shop, focus on serving high-quality handcrafted beverages. Expected earnings growth rate for the current year is 30%. They give it a 1, which I think is a buy, I think, on their scale. I'm not sure. Let's see what Jim Cramer said about a week ago. Where is it? When asked about Dutch Brothers, he said, "I like the situation." Ah, crap. Oh, no. Okay, so $30 might be incoming. I don't know. Oh, man, this guy Kramer. It's funny because when he gets something right, people will be like, well, the guy's got like 48 years experience. What do you expect? And then other people will be like, bro, this guy's always wrong. I always bet Oppo. I go opposite Jim Cramer. So, oh, man, if he's talking about it as an investment, I agree with him. Here, I like the situation. If we're talking about an earnings play, I don't know. The stock, again, might be due for a 10-12% pullback. I don't know. But I really don't know how that sits with me. But, I mean, I guess it could be a feather in the cap. We'll try to look at it through the lens that we want to, right? We have earnings, yep, coming up. Need to take advantage. Zacks. Seems like Zacks is really covering bros here. Look at all these Zacks articles. Dutch Bros maintained $45 by Wedbush. You can see it's about a 33% move from where we currently are. Not too bad. Most analysts seem bullish. I think the lowest price target I saw was about 32 maybe. So even if it does have a pullback, again, we might see a little step down here with these earnings, back to the bottom of this channel, and then we keep stepping up here inside of this channel here. Okay, where's my news? Come on. There we go. Yeah, see, and then we go back the month prior, and the insiders sold again. And you can see here, sold almost 400,000 shares for $13.5 million. And now had 165,994 shares. But we just read a week ago, right? Because this is a month and a half ago. So we read a week ago that they just sold another roughly 40,000 shares. Now they're down to 120,000 shares. So we're talking about roughly 430-ish thousand shares that were liquidated over about the last 6 weeks, equating to about 15 million, it looks like, or, off the top of my head here. So that is interesting as well, because, that might be kind of telling that we may be due for a pullback as well. They might feel that right now in the moment the stock is overvalued. So if they take a hit, they might want to secure and lock in, again, tens of millions here at that 35, 36 level, it looked like. So that really is one of my main red flags at the moment. Yeah, it seems like they sold between about 34 and 36, it looks like. And you can see right now the stock exactly mid-range there at 35. So it's very difficult. TD Cowen, $47 price target. Sold 280,000 shares for $9 million. Still holding 322,000 shares. A lot of these insiders trimmed positions. And of course, if you're someone who follows insider buying and selling, then obviously, technically, you're viewing that as a bad sign. So this is why we may kind of see a big drop before we see the steps back up. We sell shares. Shares sold. Dutch Brothers cut to neutral from overweight by Piper Sandler. This was corrected, whatever. Price target cut to 36 from 41. So that is, I believe, one of the lowest price target. No, we got a $31 price target. So we have 14 analysts currently covering the position. All of them are basically saying to either buy or hold. 10 giving a strong buy, 1 giving a buy, 3 saying to hold. Price target average 40.64. Lowest price target 31, highest price target 49. But again, the EPS has been solid. It's been more profitable than Wall Street anticipates. And I think they kind of stay the course. Unless we see a random surprise big revenue miss, I really don't think there's much to be concerned about, especially over the longer term. In the short term, anything can happen. But over the longer term, I like it. I do like it. And again, we have a lot of stocks that are overextended. So while we can make the argument that it could drop or it could pop, you know, to be trading roughly 5 times, quote unquote, my fair value, or roughly 5 times, you know, annual revenue, might not be too overextended. So this is why if you're bullish on bros, I get it. Also, if you're bearish on bros and you're looking for like that 32 entry maybe, I can understand that as well. I can. But in my opinion, it does seem to be growing nicely and the numbers do seem pretty healthy. So if you did want to start building a position or you started already and you're looking to, you know, keep adding an average down, you know, I can't necessarily call you crazy because I like to follow the numbers a little more than the technicals, excuse me. Way too much coffee today. I like to follow the numbers a little more than the technicals, and the numbers really don't look too bad. RSI got up here above 60. You can see we pulled back to about 58.4 here on the daily. And again, technically, this is our kind of immediate short-term support level that we popped up to and have been stepping off of. So we have to watch that trend line right there. And if we do happen to go below it, we may see a retest right around both of these moving averages and even the mid-Bollinger Band, which would be, see this big pop, would be about half of that big pop, right? Would bring us back down to the 33s. So we have the 50-day at 33, 200-day 33.29, mid-Bollinger Band 33.68. So that's why I think a pullback of, you know, roughly 1.5, 2 points could be coming here before we maybe see a little rally going into next quarter's earnings. MACD, we had a couple of crosses, but we crossed to the upside. After the big chunk down, you can see, look, the MACD was starting to curl, and then the earnings came out and they chunked the stock down. And then just within a couple of weeks, it started to climb and then crossed to the upside. That added to the surge. Crossed to the downside, big sell-off. Cross back to the upside, big spike up. Now you can see the curling. That's why we may kind of come back and quiet down a little and flatten out and then bounce and run going into those earnings. So in my opinion, keep that potential trajectory in mind. RSI on the weekly, roughly 53. And after the big drop, you can see it's basically, for the most part, been healthily holding and bouncing off of this 50-day moving average, which, as you see, 32.76, which is why I'm saying we may see a drop before a pop. However, because we went down for about 3 years, we could also be seeing this slow U-turn recovery, which is why, again, I'm saying if it's another nice beat a pop up to 40 does seem realistic as well. Also, on the weekly, look at that. MACD right at that cross, potentially ready to pop up. So, what's today? Tuesday, right? Yeah, so we may like pull back and then explode, or we may just explode off of this MACD cross. So we have to wait and see how the next 1, 2, 3 days transpire. But we can come back to this maybe at or right after earnings. We'll do another update because I know a bunch of people are in watching this one. They're interested in this one, but very interesting potential cross gearing up right there for the MACD on Bros. But yeah, right now we may. It could be played, of course, as a trade. But I don't know. I don't know if I would personally bank on a pop or a drop necessarily this quarter. I would probably lean more towards slowly accumulating shares. And again, if it does really drop down, then that's when you can maybe think about going in heavier. But we'll see. We'll keep an eye on it, and we'll see. We'll come back to it in about a week, and we'll talk about those earnings. We'll see how the stock runs or drops going into earnings, and then we'll look at the actual numbers reported and whether it's a justified move up or down, and then we'll reevaluate the situation from there. But yeah, I guess that's pretty much it. So I'll end it there. Once again, this is Stocks by the Numbers. I want to thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comment section. I'm usually pretty quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But of course, more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for your time. Have a good day.